Hello friends. Last week in my video, I discussed with you the salient points of how to know if bears would be forced to cover their shorts and the indices would go up. Now, I hope you watched those salient points and you noticed what was happening. In this week's video, I want to touch upon a query that many of my online family members have asked me. Vijay, the indices are up, but my stock portfolio is either flat or is underperforming relatively, or even in some cases negative. Why is this happening, and what you can do to gauge what you should do about this? Now, you see, I have always maintained that you and me, as real world traders, unlike academicians and passive bystanders and market watchers or commentators, have to know what is happening in the market, because we are brain warriors. You and me are not expected to fight in the boxing ring against our opponent, run faster, swim longer and faster than the other guy. We win with our ideas. So our ideas need to be super sharp. We need to know what's happening. Find out the cause and you know the effect. And do remember, nothing happens in financial markets without a reason, and the reason is invariably financial. Now, why did indices go up but your stock portfolio did not? Do remember that what just ended was the month of June. It is the first quarter of the financial year in India. And in India, for those of my friends joining from abroad, the financial year starts on 1st April, ends on 31st March. So this was Q1 of the financial year. The mutual fund industry typically buys stocks, particularly those that it is already holding, to firm up their prices and push up their net asset values, or NAVs. This is called NAV pumping, NAV boosting, NAV priming, call it what you will. And to push up the NAVs, obviously, like I said, you have to have those stocks. And secondly, being mutual funds, these guys have certain criteria in which kind of stocks they can and must invest. More often than not, most funds will have large cap stocks. And these large cap stocks are heavily weighted in the indices, which is why you're seeing the indices go up, but your stock portfolio doesn't really perform as well. Now, like I told you, I am a slave or a worshipper to data. Here, watch what's happening on your screen. I have given you a list of stocks that are in the FNO, and they are also weighted in the Nifty. What I have selected them by is a descending order of the percentage gain they have logged in price. Secondly, the second column, the numerical column, is the weightage that they enjoy in the Nifty. And the third numerical column is the impact of this price move on the Nifty itself. So what you're seeing is Reliance changed 8.28% last week. Its weightage in the Nifty is 9.75. And because it moved 8.28%, the impact on the Nifty is 0.81%. Similarly, if you were to see the top movers, which are Nifty component stocks, and you total them, you will see that the Nifty had a net impact of these stocks to the extent of 1.99%. And if you actually see what the Nifty 50 index gained last week, it gained 2.17%. So a lion's share, I would say a majority of most of the gains that the Nifty clocked was because of these stocks. Now, unless you have these stocks in your portfolio is going to be completely flat out. Like I said, nothing happens in financial markets without a reason. Find the cause, you will know the effect. Now, does it mean that this lopsided, and in technical analysis and statistical analysis parlance, this is called skew, lopsided skew. Will this skew continue in the coming weeks? The good news is that whatever NAV boosting, NAV pump priming, whatever needed to be done is over, hopefully, because end of June signified a quarter end. Now, over a period of time, price discovery mechanism should kick in, and then your prices will start to move by other reasons rather than just pump priming by big boys who are institutional players. This question about why my portfolio is lagging even though indices are rising is tackled. Now let's jump on to our usual market analysis, and I start with the weekly market roundup. On your screen right now, what we can see is that the gains were led by the broader based Nifty 50 rather than the Bank Nifty. The Bank Nifty brought up the rear. The US dollar index managed to continue to gain, which impacted gold prices marginally lower, but silver prices were up. Do note, silver is also up because of cost of carry. I have taken the next month future because the 5th July future has gone into compulsory delivery. Crude oil just about managed to gain a little because of the fears of escalation of hostilities between Israel and Hezbollah, and also the targeting of Russian oil installations in the Ukraine war. But there's nothing serious happening in oil and gas prices. So to that extent, I am not seeing a major jump here. The USD INR, which is the dollar versus the rupee, eased, which means the rupee strengthened a little. The Indian 10-year benchmark bond yield went up by 4 basis points, which means the bond prices fell. Now, since banks are the biggest investors in bonds, their portfolio witnessed a mark-to-market loss, which is why one of the reasons why the Bank Nifty underperformed the Nifty 50. Now, friends, I have recorded a special video on the Indian sovereign bond inclusion in the global debt market indices, and you can see the thumbnail up here. The hyperlink to this video is in the pinned comment below and in the description below this video. Please do watch this video to understand what will be the net impact of inflows from FIIs into our bond market and trickle down effect on equities also. The other aspect that we saw in the market was that the NSE market capitalization went up by 1.14%, which means the rally was rather broad-based. The MWPL went down by a little over 11%, which is routine on expiry, and the US headline indices fell mildly, thereby providing some amount of headwinds to our markets. Friends, now watch the relative comparison of the Nifty versus the Bank Nifty, because here lies a key metric of weightages. I told you nothing happens in financial markets without a reason, and the reason is financial. Here we are. Over a 4-week change, is the Bank Nifty outperforming the Nifty 50, ditto for 12 weeks and 20 weeks. Now, why is it important? Because banking and financial shares, as you can see on your screen, command over 34% weightage in the Nifty. Unless the banking and financial sector stocks rise, there can't be a sustainable up move in the broader markets. Now, friends, I come to our in-house indicators. I start with market-wide position limits. As far as I'm concerned, it's one of the most important metrics out there, and what we are witnessing is a fall to 31.09%, which is routine after expiry. What is noteworthy is that this decline post-expiry is higher than last month's expiry, which was at 28.55. So a larger number of bulls and bears rather have rolled over their positions to the July series, which means risk appetite is up. Now let's take a look at the turnover. This is cumulative 3 months turnover, so it is July, August and September. And this is the red one. Red line is stock futures and blue line indicates the index futures turnover. The stock futures turnover simply went through the roof. We are at a period high. This is a weekly chart spanning 20 weeks. So we are at a 5-month high as far as the stock futures turnover is concerned. Very, very robust participation from retail traders, whereas the turnover went up for indices also, but not half as much. I now come to the advanced decline ratio, which after the price is the fastest indicator of which way the trends are going. Friends, the Nifty gained 2.17% last week, but the advanced decline ratio actually fell from 1.17 in the prior week to 0.86. Remember, this is an average of all 5 trading sessions of the week, not just the Friday's level. What we are seeing is that the ratio of 0.86 tells me that for every 100 losers, there were only 86 gainers. So one Marshmallow traders were on the defensive, they were lacking buying conviction, and I've explained the Marshmallow theory in the pinned comment below. It's a separate video, and in the description below this video itself. Friends, I now come to the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Number one, basis is invariably higher at the beginning of a new derivative cycle. Number two, basis erodes over time just as options premium erodes. And number three, basis is an indicator of risk appetite. If traders are willing to pay a higher premium, that means they are expecting the prices to move much faster. So basis went up across the board in both indices, which is routine post expiry, but not half as high as in the prior post expiry bump up. So they were not willing to pay the kind of premium that they were willing to pay barely 4 weeks ago. Was it caution because markets were at all-time highs? I would think so. Friends, I now come to our in-house exclusive indicator, the impetus, and what we are seeing is both the indices which had clocked gains last week have also clocked gains on their impetus readings, which means there was higher momentum in the buying last week, which is a positive sign. For sustainability of the upmove, price and the impetus readings both should go up together. Friends, I now come to the lift weight thrust drag index, another one of those exclusive in-house indicators that you won't find anywhere on the internet. The Nifty has risen 2.17% and the LWTD reading has risen from 0 to 0.39, which means relatively higher buying conviction, and therefore declines, if any, in the market are likely to be cushioned by fresh support coming in. Friends, our in-house indicators done. I now come to the bond markets, which are very close to my heart. What you are seeing is the Indian 10-year benchmark bond yield weekly chart on your screen. The bond yield has gone up and crossed 7%. Coming as it does on the day that Indian sovereign bonds were included in global overseas debt market indices, it tells you that the bond prices fell rather than become very enthusiastic and gung-ho. Why did this happen? Everybody, every Tom, Dick and Harry and his Uncle Joe and Aunt Henrietta were talking about a magic moment in the Indian markets because the bonds were getting listed in the overseas exchanges. In this video, which I have recorded barely 24 hours ago, I have explained to you what to expect from the Indian bonds getting listed. Is it a positive move? Yes, it is. But there are a lot of caveats here. So please familiarize yourself with this video, because whether you like it or not, banks are the biggest buyers of bonds, and whatever happens to the bond prices will impact your banking stocks price and the bank Nifty's price. So whether you're an investor or a trader, you can't ignore bonds at all. Friends, the bond market's done. I now come to the bank Nifty, which was a relative underperformer. And as you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions. The index hit an all-time high last week but eased on Thursday and Friday. The price is above its month-long moving average, which itself is trending higher, so the short-term outlook is positive for now. The price is above its bullish wedge trend line, So that trend line becomes a near-term support at approximately 51,000 levels, give or take a little. Moving on to the weekly chart, what we are seeing is a bullish candle, but that candle has a fairly prominent large shadow, upper shadow. That tells me there was some unwinding at higher levels. The weekly high is at 53,181, and that level needs to be broken above, overcome on a sustained closing basis for a fresh move to start. The price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive for now. Friends, the Bank Nifty was number 3 on the most volatile counters list based on statistical beta rankings that I maintain in-house. It rose one notch from number 3 in the prior week to number 2. That means the challenge level for retail traders went up. Last week, I advocated a range between 53,300 on the upside and 50,025 on the downside, which held perfectly well. In the coming week, I anticipate a range between 54,025 on the upside and 50,675 on the downside. Friends, in addition to these outer levels, please also consult our daily, weekly and monthly pivots that I update on our free Telegram channel. That will help you laser precise your entries and exits. Friends, the Bank Nifty done, I now come to the Nifty 50, which outperformed the Bank Nifty, gained on 4 out of 5 trading sessions last week, with Friday being a noteworthy day when some amount of profit taking came down, which was indicated by the LWTD indicator on the daily basis, which I update on our social media channel. Now, the index is trading above its month-long moving average, and the moving average itself is trending higher, so the short-term trading outlook is also positive. Now, why is Friday's price so important as per technical analysis? There is a special video that I have recorded which I want you as a part of my online family to watch and make out for yourself why this price is important for you to know. Once you've got the hang of this video, I will make another video as to why the last 60 minutes of trade are very important, and more so on every Friday. If you're connected with me on social media, here are my contact coordinates on the screen. Please do connect with me on our Telegram channel. That's where I put all our research, thoughts, trading blueprints, etc. under one roof. Now, you've read many a times on Thursday night, I write to you, watch the last 60 minutes of trade particularly carefully because Monday's opening levels depend on it. That's fine, but why? What is the underlying reason? That video is forthcoming, but first, why is Friday's price very important? Watch this video as well. So friend, let's now go to the weekly chart, which shows a higher relative strength in the Nifty 50 as compared to the Bank Nifty, which is what I have written even in my Live Mint column, which is India's first and only media column to offer statistical inputs to its readers. Now, last week's candle is a power candle, and the close is nearly at an all-time high. That indicates relative strength in the Nifty. The Nifty right now is in blue sky zone, which means at an all-time high, where overhead supply coming from people who are trapped at higher levels will not come. Only short selling is the concern for bulls, and that is a part and parcel of market trading. However, in last week's video, I have given you enough hints about how to know, enough leads rather, not even hints, out and out leads as to how to know when bears are starting to cover their short positions. So do keep monitoring the same signs for any proactive short covering in the week ahead as well. On the weekly chart, the price is above its 25-week exponential moving average, which is a proxy for the 6-month long holding on cost of an average bull. So the medium-term outlook is also positive for now. Watch the Bank Nifty along with the Nifty 50 for the simple reason that banking and financial stocks have a weightage of 34% in the Nifty itself. So to that extent, Both these indices are conjoined at the hip, just like you have Siamese twins. One will not move without the other. Friends, in the week before last, this index was ranked number 21 in most volatile counters list based on statistical beta rankings that I maintain in-house. It jumped to number 9, which means volatility jumped up. That's always challenging for an average retail trader. Last week, I advocated an estimated range between 24,100 on the upside and 22,900 on the downside. Well, the high it formed was at 24,174, which means the index went 74 points higher than I anticipated, which is a very small margin, but I do admit I got it wrong by 74 points on an intraday basis. In the coming week, I estimate a range between 24,625 on the upside and 23,400 on the downside. Friends, in addition to these levels, please do watch the daily, weekly, monthly pivots that I put up on our free Telegram channel. They'll help you laser time your trades even further. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by way of the contribution of turnover in the 4 derivative segments. On your screen now is the weekly chart wherein the index futures turnover contribution has gone up by 2 basis points as indicated as a blue line. Stock futures turnover contribution has gone up by 21 basis points indicated as a red line, which means the higher capital demanding futures segment, also the higher riskier segment, is witnessing higher participation. There's no doubt about it, the retail shows higher risk appetite. Index options, which are relatively the safest instrument out there between options and futures, saw a 58 basis point jump in turnover contribution, which is indicated as a green line. And stock options turnover fell by 80 basis points, which is indicated as a purple line. Not much of a surprise. It was an expiry week. In expiry, people tend to roll over their futures more than options. So options tend to expire worthless, which is why the turnover fell. Friends, now I share my strategy for the week ahead, and I continue to stick to my tail risk hedges, the Hacienda hedges, which I have explained to you. The hyperlink to the Hacienda hedge write-up on our Telegram channel is in the description and in the pinned comment below. I will continue to focus on public sector stocks, PSUs. And why do I like PSUs? What is their typical price movement? How to tackle these prices? And the typical snapquote window and the volume weighted price moves is something that I have given in this video. Please do watch this video. The hyperlink is in the description and the pinned comment below. Do remember that PSUs will also form a very large component in many mutual funds. With the end of June, many of these PSU counters would have also seen institutional activity. Now that the quarter ending is over, some amount of gravy dressing is done and dusted, and price discovery mechanism will kick in over a period of time. Even within the PSU space, I remain polarized around oil marketing companies, which is OMCs, power generation, power distribution, and energy counters. Metals prices basically might see a little bit of an uptick on commodity exchanges. What does it have to do with you and me? Because we as stock traders will see the prices of metal mining companies get as volatile or little volatile as and when the prices move in tandem with commodity prices on the exchanges. As far as I'm concerned, I've laid my cards pretty clear. I do not subscribe to the super cycle theory either in energy or in industrial metals. Yes, I'm bullish on bullion, but those are not industrial metals. So at higher levels, I anticipate some amount of profit taking in industrial metals, which will reflect again on stock prices of those companies. I remain a theta decay player in oil and gas. And what I mean by theta decay is non-linear option trading. I've explained to you in this video of option trading part 1. Remain assured, part 2 video and thereafter many parts are still work in progress. We are working on them and they will be released in good time. So I will continue to be a theta decay player in energy, both crude oil and natural gas. Also on my social media account since 21st of June, every day I have updated you with how option writers are having an upper hand over option buyers. Giving you an example of July 7,200 call options in MCX WTI crude oil. It could be any other counter. It could be individual stocks. It could be the Nifty. It could be the Bank Nifty. Do remember why I talk about bonds, because the concept of cost of funds is very dear to me. It's the very basis of finance. If cost of money is going to go up, everything risky assets are going to witness some amount of demand crimping. So option writers are extremely sensitive and sensible people to cost of funds, and they've mastered the concept very well. They know how to write options and at what strike prices. So you do familiarize yourself with options video 1. As far as bullion is concerned, I do anticipate some amount of consolidation, especially if the US dollar index is likely to remain firm. But lower levels will witness buying cushions coming in from institutional players. Friends, if there are any more trading ideas that I can think of, I'll happily share them on our free Telegram channel. Please do make it a point to connect with me there. I thank you for your patience in being with me in this video. And before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know what you would want me to record for you in my future videos. Also, a request for help. Please share my videos with like-minded people like yourself and smart traders so as to enable me to broaden my reach and reach out to far more traders to help them take informed decisions. I wish you have a very profitable week ahead. This is Vijay Bambwani signing off for now. Take care. Bye-bye.